Hello everyone, I'm Sahil and welcome back to the channel. So in the past, right, it has been nearly impossible for Chinese companies to list on an exchange. Since to list on a Chinese exchange, they have to be first approved by Chinese government. In other words, Chinese government picks up the companies that can list on the Chinese stock exchanges. Hence, they have been deprived of capital that they could raise through sales of equity and could only rely on debt. However, for tech companies, it is very important that they could access capital through equity, because raising debt at for a tech company startup is nearly impossible as well. So a lot of Chinese companies found a listing outside of China in order to get access to foreign capital instead. And obviously their main choice was US, the biggest capital market in the world. So you saw a lot of big Chinese tech companies listing on US exchanges, especially Nasdaq, Alibaba, JD, and many more. However, since 2019, they have rushed to get a secondary listing on Hong Kong Stock Exchange. This is due to the ongoing tensions in between US and China, and also the US pressure on delisting Chinese companies like they did with the telecom companies earlier this year. Alibaba, JD are such examples who have already made the move and are already listed on the Hong Kong Stock Exchange. This has left investors with a choice in choosing one over the other exchange to invest into such companies. Together with the option, you also have a lot of confusion on which one to choose, and there have been a lot of misleading information on the internet regarding the same. So in this episode, I'm going to iron out some of the details for you so we can make an informed decision in choosing one exchange over the other. So let's set it up. Alright, so while on this topic, right, we'll come across these two words very frequently. Firstly, ADS and then head shares. So let's figure them out before we move on to the comparison. So firstly, ADS, right, which stands for American Depository Receipts and refers to shares of foreign companies that are held by US depository banks and are available for the investors to purchase from any particular US exchange or OTC in US dollars. Whereas head shares are shares of the companies that are incorporated outside of Hong Kong and are listed and traded on Hong Kong Stock Exchange in Hong Kong dollars. Before we go into the differences, there is this very big misconception or misinformation that is being spread around by people on the internet, and that is the main reason I wanted to cover this topic. The misconception is that when you buy ADS or US listing, you are actually buying into a shell company with a variable interest entity structure or VIE structure. Whereas you buy Hong Kong shares or head shares, you're buying into the actual company. To better understand the misconception, let's understand the VIE structure first. For the same, let's take an example of Alibaba. So in a VIE structure, a shell company, which in Alibaba's case is incorporated in Cayman Islands, is contractually obliged to a certain portion of Alibaba's profits. And this is done in a very shady way. So on paper, the shell company is providing some consultation or IT services or something along that line to Alibaba, and Alibaba is paying them for these services. But in reality, there's nothing like that. But it's done in a way that the shell company mimics the performance of Alibaba itself. So now this is true that when you buy ADS, you're actually just buying into the shell company, not the actual Alibaba that is incorporated in China. So as such, you have no ownership stake in Alibaba or any voting rights in how Alibaba is operated. However, you get all the monetary benefits that arises from investing into Alibaba through that contractual agreement between the shell company and Alibaba itself. Now, the question you might ask is, why are Chinese companies adopting such a shady arrangement? Well, this is due to the Chinese policies that restrict foreign ownership in certain types of businesses. And when you're investing into such VIE, you're exposing yourself to the risk that Chinese government doesn't formally acknowledge these structures. And they're just closing an eye for now, but at any point, they can just disregard the contractual agreement and they can just revoke the licenses of such VIE. They can impose hefty fines on the company. They can force them to restructure and whatever not. So this is going to be really disruptive if such thing happens. However, China's government have been going the other direction, which is a good thing, and the risk is actually not even considered anymore in the market. So yeah, however, there have been two cases where VIE have been invalidated by the Chinese government. I will post it out somewhere here, so just give it a read if you would like to. Pause the video and read it. If not, let's move on. So up until 2018, Hong Kong Stock Exchange didn't allow companies without any voting right or even weighted voting rights to list on their exchange. However, since then, they have changed the rules, and you can now see Chinese tech companies listing on Hong Kong Exchange instead, with the likes of Tencent and Meituan. Where exactly did the misconception of head shares entitling you ownership in the actual company came from? Well, in my experience, I had the same misconception, and I will walk you through why, and then we'll talk about how I realized that this wasn't the case. So firstly, if you look at the ticker symbols of such companies, let's take example of JD, it is preceded by the alphabet S and W. So what does S and W stand for? We can find it out from the Hong Kong Stock Exchange website. So S stands for secondary listing, which obviously JD is. Its primary listing is in US. And W stands for companies with weighted voting rights structure. So this could be interpreted as you have certain voting rights in the company, even though like it's a weighted structure, so some shares have more rights than the other, which probably the management or the founder or the key personnel would hold, and they can make all the decisions, but you still have certain voting rights, right? So that means you are actually having a part of the company. So that is the first place where you can interpret such a misconception from. Also, in the new rules that Hong Kong Stock Exchange came up with in 2018, it is stated that the voting power of WVR, weighted voting rights shares, cannot be greater than 10 times the voting power of non-WVR shares. Also, non-weighted voting right holders must hold at least 10% of the votes. This implies that you have the voting right into the actual company, and also that, in other words, you have ownership of the actual company. But really, when did this happen? When did CCP change its stance on foreign ownership of these businesses? They didn't. So what exactly is happening? Upon digging deeper, I found out that HKSC has some waivers for secondary listings which have primarily listed on a qualifying exchange on or before 15th of December 2017. So this includes companies like Xiaomi, Alibaba, JD, and so on. For these companies, they are waived off the WVR safeguards of having minimum 1/10 voting rights, and also they are able to list with their existing VIE structure as long as they provide a PRC legal opinion that the VIE structure complies with the laws, rules, regulations applicable in the People's Republic of China. In other words, as long as the PRC government acknowledges the VIE structure. So this is good, right? Because if the CCP acknowledges the VIE structure, all the risk that we mentioned earlier is actually washed off. However, I couldn't find any such legal opinion for Alibaba or JD, and also in their annual reports or their any earnings reports, they clearly mention the risk involving the VIE structure, and that the Chinese government can actually take all the actions that we mentioned earlier at any point of time. So in the end, the gist of the thing is, no matter which listing you buy, US listing or head shares, you are actually buying into the same shell company and the same VIE structure. So there's no real difference. If the Chinese government acknowledges the VIE structure, both the listing are getting the same benefits, that the same shell company is actually acknowledged by the PRC and they cannot take action against the contractual agreement then forth. So yeah. Even in the case of new listings such as JD Logistics, which is currently in the process of getting listed in Hong Kong Stock Exchange. So I went through their pre-listing filings, and then again they have mentioned the risk involved with the VIE structure, the corporate structure that they are taking up. You can find more details in the pre-listing filings yourself. And there are some here as well. Do root through if you want to. So they clearly mentioned, in the JD listing, they have a contractual agreement where they are providing certain control over the actual company to the shareholders. However, it's still through a contractual agreement, not direct ownership, and they have clearly stated that it is not as effective as a direct ownership. I will be also doing a video on JD Logistics soon, covering their listing. So if you are interested, just stay tuned. I mean, you have to subscribe and then stay tuned. Now let's move on to the differences in between the two listing. So for US listing or the ADS, you have the advantage that there is no lot size, so you can even buy a single share if you'd like to, which is a very beneficial if you'd like to dollar cost average. If you'd like to invest a certain amount every month, like $2,000, you can just buy as many shares that comes with that amount of money. Also, the trading fees in the US market is very, very low, and even zero for some cases, zero commission, I mean. Lastly, the market data offered by the brokers are of a higher level as compared to, I guess, Hong Kong market or any other market. The con of the US listing, on the other hand, is that there is a risk of getting delisted, and you might be forced to sell your ADS at an unfavorable price or convert them to hedge shares. I don't know the whole process of how it is done, but I'm pretty sure that it will cost you something to do that. On the other hand, for Hong Kong shares, everything is just opposite. The pro is that there is no apparent risk of getting delisted. The con is that there is lot sizes. So for example, JD has a lot size of 50 shares, so you can only buy in the multiple of 50s. So yeah, it is a certain hindrance. You can't just go and buy one share. Also, in certain cases such as Ping An, with minimum lot size of 500 shares, the minimum amount you can invest into Ping An is about 7,000 Singapore dollars, around there. So the dollar cost averaging with such a big amount is really hard for a retail investor like me. I mean, a small investor like me. So yeah, it is some kind of con. Also, the commissions are a bit higher than US stocks, but still manageable, I guess. The market data level available is also lower than US stocks. But obviously, if you are investing in companies that are listed on both the sides, most of the data you can use from US listing in Hong Kong listing as well. So yeah, it doesn't make a difference for me personally. Maybe certain high level investors, more sophisticated investors who use the data on a much efficient way may find a difference, but for me it doesn't matter. So also in my JD analysis video, I mentioned that Hong Kong does not have options, whereas US shares has options. But I forgot to mention that Hong Kong market has warrants, which are similar to options. However, according to Investopedia, warrants are issued by the company itself. Now, in my experience, I've also seen warrants issued by market makers such as banks. But don't take my words for it. I'm not really interested in options, so I'm not bothered to really dig deeper and understand what is really the difference between the two, warrants and options. And also, I don't really want to talk much about it because I'm personally not experienced in this particular thing like options. So I don't want to give you some wrong information. However, if you're interested, please go and do your own research. And if you are someone who's already knowledgeable about it, do share with us what is the actual differences in between, let's say, JD's warrants on the Hong Kong exchange and options on the US exchange in the comments below. And I think it will be beneficial for everybody over here. With all that said, I am personally buying Hong Kong shares only as the US is getting more and more unstable with time. It is funny how tides have changed, but it is what it is, and I feel more secure having a position with hedge shares than having the US listing. And the cons of the lot sizes and all actually does, in front of the delisting risk, it doesn't really matter. So yeah, that's all for today. I hope this video was of some value to you. If it was, do like the video. It will be really helpful for me. Until the next episode, ciao.